Take a break from staring at your crippling stock market losses. It's time for your weekly market update with Ryan G from Mortgage Right Folsom. All right, guys, we got a lot to pack into this one, so let's jump right into it. Last week, we got inflation numbers for May, and it was even worse than expected, rising 1% last month alone versus 0.7% expectations. At 8.6%, inflation is currently the highest it's been since 1981. A particular note in this report, food costs have rose 1.2% in May, bringing the year-over-year gain to 10.2%, meaning that food is over 10% more expensive now than it was this time last year. Fuel increased 16.9% in May alone, bringing it 107% higher than this time last year. Across the country, gas is over $5 a gallon, which is the highest it's ever been. So how does this relate to mortgage? Not only does inflation lead to higher costs of goods, but it is also the arch enemy of fixed investments like mortgage bonds because it erodes the buying power of a bond's fixed rate of return. I'm not going to explain what all of that means, but what you need to know is that if inflation is rising, investors demand a rate of return to combat it, causing interest rates to rise like we've seen this year. All right, in housing news, Zillow released their home price expectations survey for the second quarter. This survey, which is released every quarter, asks a panel of over 100 economists, investment strategists, and housing market analysts about their 5-year expectations for future home prices in the United States. Of the 114 economists surveyed this time around, participants said they expect home prices to appreciate 4.8% on average per year over the next 5 years. Respondents were also asked, do you believe that the U.S. housing market is currently in a bubble? Of the 98 respondents with an opinion on that question, 65% answered no. Some of the reasons they provided for this belief included continued low housing inventory, recent price growth caused by fundamentals like demographics and shifting housing preferences, rising rents, the work from home revolution, and high homeowner equity. So while it might not be easy to buy a house right now, it should still certainly be a smart financial decision. Interest rates rose modestly across the board, but without getting into the nitty-gritty on mortgage bonds, trust me when I say there's a lot of room to the downside, which is bad for mortgage rates. If you've been waiting, time is now. 2022 is already the worst year for mortgage rates since 1979. Don't let it get any worse before getting an estimate. All right, what to look out for this week? We do get some more inflation and housing data this week, but all eyes are on the Fed, who will be meeting on Tuesday and Wednesday later on this week. Remember that the main tool the Fed uses to curb inflation is hiking its benchmark federal funds rate, which is the interest rate for overnight borrowing between big banks and is not the same as mortgage rates. So it's a little bit counterintuitive, but when the Fed hikes its benchmark rate, this can actually be good for mortgage rates because it curbs inflation. The Fed is expected to hike its benchmark rate by 50 basis points at its next meeting this week, and investors will closely be watching that and what actions they take and what comments they make regarding inflation. All right, guys, that's a wrap for this market update. Keep your eyes on the Fed and keep your head on a swivel. We'll see you next week. This is Ryan G with Mortgage Right Folsom.